All right, we should see the disclaimer and we should be back online again. I think we're live now.
All right.
All
Sweet.
right,
Made it.
beautiful. All right,
Woo!
so welcome to episode 11. As usual, let's start off talking about the market here. We are on our sixth day in a row of green on SPY. Wrote about this a lot in the newsletter. I've been adding slowly equity exposure back every day. Every day that we're up, especially the days where, the bears try to come in and knock it down like yesterday and the bulls come back in force. It's giving me more and more confidence, at least short term. Markets still got to get through the 50-day moving average, still got to get through the 200-day. 50 days still has to cross above the 200-day. A lot of stuff going on. I am still about a third of where I was in equity exposure, during DeepSeek. So, by no means do I think we're out of the woods. I think you got to keep your head on a swivel. But, I've been saying I think the lows are in. Would not be shocked to retest them, but now we're so far from that level, you'd really need something bad to happen. So that's my thought. More and more trust in this market on the long side every day, but still be extremely careful. Jeremy, where do you come in on this?
Yeah, I'm at a point where, pardon me, I didn't flatten everything yesterday. I did post in a swing trading group that I'm waiting flat on QQQ until things break out of this pattern because it's been consolidating straight for 3 days now. Oh, this will be day three. But I did take a lot of risk off on all my equity positions to where, I'm just waiting for the next thing to happen. And we're set up for either a leg up or a leg down here, of course, from what I can see. And some of the equities are really starting to look appealing. What's that?
I said that's brilliant. We're set up for a leg up or a leg down.
Yeah. I mean, when we see a consolidation sideways like this, we always kind of, as a trading community type of thing, I would say, don't trade the setup, trade the break. And that kind of always hits home when I see it go sideways. Although it's in range and it's closed positive for 3 days in a row, 6 days in a row now. The consolidation point is kind of in a range. So when I see a range like that, I'll usually take some risk off and wait on the wings with either a new position ready to go, or sometimes I'll sit in cash and just wait for some more options to sell. So I'm just kind of biding my time, risk off at the moment. I've taken profit from the bottom of this setup, so I'm pretty happy with what I did. And then, you saw my post about NVIDIA yesterday, or a little talk about yesterday with NVIDIA. It's kind of hitting that teetering point where it could go either way. There's a lot of news heavy on that. With the current situation.
Those Huawei chips are concerning.
Yeah. And I think until that cloud passes by, we're going to be sitting here in limbo waiting for this to break. So that's just my theory on it. I think everything's waiting on NVIDIA again.
All right, cool. Looks like we might be about to go negative, but we'll see. Pat, you want to introduce our guest?
Okay, this is Rebel Cole. He is the Lynn, eminent scholar, chair professor at the University of Finance at Florida Atlantic University, which is in my old hometown of Boca. Beautiful spot. He also is at he's economist at the Board of Governors at the Federal Reserve in Washington and in Dallas. He leads this thing called the Banking Initiative at Florida Atlantic University, right? And he makes actually really good posts on LinkedIn. I highly recommend you follow this guy. He has one of the best commentary guy I've seen. Really good stuff. And he talks commercial bank real estate exposure quite a bit. So I thought I'd have you on. Welcome, Cole. Why don't you hit on any of those topics if you'd like?
It's my pleasure to join you here. Pick a topic and we'll jump into it.
Extend and pretend.
What's that?
Extend and pretend.
Extend and pretend is my favorite, also known as Galay and Pray.
Yeah.
You survived
Let's
until
go.
25, now survive through 25.
Right. Okay.
So extended pretend is a function of interest rate risk. We had this incredible shock to interest rates in 2022 when the Federal Reserve raised the federal funds rate at the fastest pace in its history, from essentially 0 to more than 5%. The 10-year Treasury responded as you expected, went up not as much as that, but rose substantially. And when you have rising interest rates, as we all know in finance, when rates go up, the price of bonds go down, and so do the price of bond-like instruments. So we saw that the banks lost $500 billion in the securities portfolio. They probably lost a similar amount on their residential mortgage portfolios. And interesting, they are likely to lose a significant amount on their commercial real estate exposure, which is interesting because commercial mortgages by themselves do not have interest rate risk the way that, say, a 30-year fixed rate mortgage is. Most of these are 5 or 10-year balloons. But what happens is those balloon loans convert interest rate risk into credit risk when they mature. And not just mature, those that reprice. There are 5-1 arms in commercial real estate, just like there are in residential real estate. And we know what happens if you had a 30-year mortgage that needed to be refinanced today or anytime last year, you were going from like 3% to 7%. Well, that same phenomena is hitting the owners of commercial properties. So what has happened is the banks have found an interesting way under the new accounting regime that is CECL to avoid classifying these loans as non-performing and having to take loan loss provision. What they're essentially doing is modifying these loans. And this used to be what we called a troubled debt restructuring, but under the new accounting rules, there are no troubled debt restructurings. So they're simply modifying loans over and over and allowing the borrowers to continue to pay 3%. So we're not really seeing the defaults that we would expect to see given a normal functioning credit market.
All right, so let's hit on that because you're in one of my favorite areas. So back in, I guess it was whenever the regional banks were going under, whenever Silicon Valley went under, where there was 20, what's
2 years
that?
ago.
March 23.
23. All right.
That was
So
fun.
I made a lot of money shorting regional banks back then, and I'm an ETF guy. So I'm sitting there saying, hey, there should be an inverse regional bank ETF, and there wasn't. So I created one, SKRE, with the thinking that, even though, all right, Signature went under, Silicon went under, maybe one or two others, I don't remember. And then that was gone. My thought was, well, wait, we've still got the commercial real estate exposure. We've still got the fact that these banks probably woefully managed their treasury portfolios. I think we're going to get another wave. And we have been. SKRE launched at 25. It's now at 1469. So, it has not worked out as I had thought. But, my thinking is I'm not as concerned about what the money center banks have because they're too big to fail. A regional bank is not. And my sense has been that at some point this is going to come to a head. And you're going to have a bunch of these banks forced to sell to JP Morgan for pennies on the dollar. So what do you think about that?
I concur wholeheartedly. If you look at my analysis on LinkedIn, the large banks, the JP Morgans, essentially the Dodd-Frank stress-tested banks, the regulators have kept them from getting the sort of exposure to commercial real estate that we're seeing among the regional banks. So they're really not exposed the way that the other banks are. And as you also say, they're too big to fail. Another interesting fact, though, if you look at the non-performing loans in commercial real estate, the big banks, JP Morgan, not JP Morgan, but Bank of America, Wells Fargo, they're reporting like 5 and 6% NPLs. You look at the regional banks and they're like less than 1%. Now, yes, maybe the big banks have a few more exposure to office and blue cities, but there's no way that you can tell me that Zion and Bank OZK are 5 and 6 times better at managing their credit risk than Wells Fargo and Bank of America. And what it really is, it comes down to this accounting subterfuge where the big banks are not really allowed to do the same degree of extend and pretend because of their internal audit function that doesn't exist at these regional banks. So I wholeheartedly agree. I don't worry about the big four banks, the $4 trillion banks. The regulators don't worry about them, and they don't really care about anybody else. There's still 4,500 banks in America, and I'm pretty sure that the regulators would be fine if there were 450. So if 1,000 banks disappear the next year, the regulators aren't. They're probably going to say, "Great, that's less work for us to do. We don't have to regulate those banks." So they definitely will let these regional banks fail. There are, I think, 156 banks over $10 billion, and you take out the 4 or 5 really large. So you got about 150 regional banks that you got to worry about. And the real risk factor that most people don't pay attention to is the uninsured deposits. So uninsured deposits are like a tinderbox. All they need is one spark to light them up, and then the bank goes up in a conflagration. And we saw that with Silicon Valley. We saw it with Signature. We saw it with First Republic. So all we need is to have one bad news story about one of these regional banks that has a lot of uninsured deposits. And virtually all these banks over $10 billion get at least half their funding from uninsured deposits. I actually have a screen on our Bank Initiative website where we compare uninsured deposits to liquid assets. So you can actually see which banks are the worst. And there's some that are
that
like
one up, Matt?
Pardon?
Oh, yeah, Matt has the link for that, I'm pretty sure, right? Or at least the U.S. bank exposure. Yeah, right here. This is yours, right?
All right, yeah, that one in red there, uninsured deposit liquid assets. So you can actually see which banks. You'll see at the top, some of them are like 3 to 1. So they have 3 times more uninsured deposits than they have liquid assets. And like, just look at Dime Community Bank. I think they're like number 1 or number 2 on my commercial real estate exposure list. So if you do the cross tab between this and the commercial real estate exposure, which I have not done yet because that's just making it too easy for investors. But you do that, you're going to find some banks that are really, really highly exposed both to commercial real estate and to this liquidity risk. And like I say, all it takes, there's Dime at number 2, is one really bad news story. We saw that happen to Flagstar last year. They announced they were writing down, I think, 2 mortgages, and their stock price then dropped like 25%, then 50. I think it ultimately dropped almost 90%. They're still around, still alive, but that just sort of shows what can happen when there is negative news. And that ties back into extend and pretend. So why aren't these banks selling off their bad commercial real estate? And what I've heard from industry players is they don't want a public record reflecting the sale of an asset at below par value, because that could trigger a run on their stock price and or a run by uninsured depositors. So we're simply not seeing transactions. I was working with a large private equity firm that had a distressed real estate fund. We had a gentleman from Kane Anderson at our conference here in Boca last December. They have a big distressed fund, and nobody is able to place any money because the bankers are all saying, "Oh, my portfolio is fine. Go talk to that guy. He's got problems."
Wow.
Interesting. So
Do you do this? Can I ask you a question? Do you use stuff in the class at your school? Do your kids do this, or your students, or is this stuff you do, or a little of both? Because it's really cool stuff.
This is just me. My background, I wrote my dissertation on commercial real estate back in the 80s. Like I say, I worked through the savings and loan crisis, the banking crisis of the 80s. So I'm just sort of uniquely positioned with my background in commercial real estate and banking for this particular banking crisis.
Got it. Sorry, man.
yeah, so yeah, it's this whole uninsured thing is interesting to me. I can't, and that's one of the other reasons why I'm negative on regional banks, because you can move money extremely quickly. Yeah, it always amazes me why people keep over the uninsured amount at a regional bank. I mean, all of my main accounts are Wells Fargo, I mean, I don't like Wells Fargo. I've got First County Bank right around the corner. They're great to deal with, but I don't want to have big money over there because I know Wells Fargo is not going under. I don't know about
Raised
First
two really
County.
good issues. The first is, why do uninsured depositors keep all their money in one bank? And the second is the speed at which money runs today. Silicon Valley lost $40 billion of their $200 billion deposits on March 9th. Fastest run in history. The second fastest run was $16 billion over 30 days at Washington Mutual back in 2008. On March 10th, the regulators expected them to lose $100 billion more. That's why they had to close them in the morning instead of waiting until Friday afternoon and close them like they normally did. Now, why were they all there? Why were these uninsured depositors there? These are largely borrowers from these banks. And when you borrow from Silicon Valley or these other banks, they say, you have to keep all of your deposits at my bank to help fund your loan, or I'm not going to extend a loan to you. So they're kind of coerced into keeping their uninsured deposit there. So, you got payroll, so you got $10, $20 million, and the bank goes under, and all of a sudden you can't pay your employees. But that's why that's happening. And your point about the speed of bank runs, it's unprecedented because of the technology. That you can set up a wire transfer on your phone and move $50 million. And it used to be your banker would call you and say, hey, what's going on? But now they just let it go.
The other thing that's interesting on this site is unrealized losses on investment securities. Is that mostly treasuries that they bought at 0% that are now at 4%?
Can I answer this question? Because if you read his research like I did, you would know what CMBS is, right? No? Correct?
Actually, no, it's RMBS. It's RMBS.
RMBS.
Close.
So
We'll let Rebel answer these questions.
Yeah. That was a good one, though.
I have a new research paper with my co-authors, Susan Wachter at Wharton, Larry White at NYU, John Taylor at Michigan State, and Brian Silverstein at South Carolina. We call it Revenge of the S&Ls, how the banks lost $500 billion in 2022 because of this interest rate risk. And what we found is that, surprisingly, the biggest portion of securities is RMBS, residential mortgage-backed securities. And it's the worst of the worst because it's 30-year fixed-rate mortgages. It has the longest duration by far. And Brian and I have another paper called Reaching for Yield, where we show that the banks actually extended their duration of their loan portfolio, their securities portfolio and their loan portfolio during 21 in Reaching for Yield, because they have there was an unprecedented spike in deposits in 2020-21, $5 trillion. All those stimulus checks went into the bank, and the banks had nowhere to put it. So they invested them in securities because there was no credit-worthy borrowers out there during the pandemic. But they wanted to get a little bit more yield, so they went out on the yield curve. And then that slapped them squarely in the face in 2022 when the Fed said that, inflation is transitory. Oops, it's not so transitory after all. We got to raise rates by 500 basis points.
That was fun.
So are they allowed to keep this stuff on their balance sheet and not recognize the loss because they're not planning on selling? Is that how that works?
Well, you think that maybe they would have a portfolio for held to maturity and a portfolio for available for sale. They have to mark to market. And that's, if you see here on this page, they actually do have an available for sale portfolio. But in 2018, the regulators decided to allow them to opt out of marking those to market. So, so none of this gets to market except for there's about 20 banks, the big banks, that do the complex approach to interest rate risk on their regulatory report. They mark to market. So Bank of America, they have $100 billion in unrealized losses. They had to mark to market those. But everybody else, and I thought there was a column here that said to opt out or not. In my LinkedIn post, tells you whether they opted out or not. But yeah, these are held to maturity. You don't have to recognize the losses unless you sell them. But if you sell one security, you have to mark the entire portfolio to market.
Oh my goodness!
So that means they have no liquidity.
Yep. Zero.
As soon as they sell this is what happened to Silicon Valley. They sold a couple of securities on Tuesday, and by Thursday they were dead.
Wow.
All right. So I've been thinking that their treasury bond management was an issue. What you're saying is RMBS is much, much bigger.
It's a bigger exposure. and RMBS are primarily 30-year fixed rate mortgages where treasuries may be 10, 5, or 1.
Okay.
You can actually look at some information about that for each bank on their call report. But by bulk, most recently, 70% of the losses as of Q4 2024 were in the RMBS portfolio.
And I don't know whether you look at interest rates or not, but me as a trader, I've been a big believer that interest rates are coming down. I think there are two Trump trades. One is European defense stocks, and the other is betting that interest rates are coming down. If I am right, which is an if, it would seem like it would help this issue. Or am I missing something?
That's the
Holy Grail
premise of extend and pretend. Extend or delay and pray for interest rates to come down. But they've been praying for 2 years and it hasn't happened. And I would disagree with you, because as long as we're running $2 trillion fiscal deficits, we're not going to have interest rates dropping below 4%, unless there's a major crisis like we had a few weeks ago when they briefly dropped below 4%. And I was thinking, gosh, the banks must be doing, cartwheels over this.
Yeah.
But then they quickly jump back up to 4.6. I think they're down to 4.2 today or so. I think we're going to see them back over 5 later this year.
Okay, which would make this problem even worse.
4 weeks ago, Rebel, you had said you thought inflation's back on the rise. I mean, we've been a little all over the place here with guys. I think most of our people have said they think they're coming down a little bit, but I'm probably more in your camp, really, honestly. What do you think about that? Yeah. Yeah.
I'm sorry.
Oh, can you guys hear me?
Yeah, we can hear you. I wasn't sure who you were asking.
No. I guess I'm just asking you about inflation. Going up or going down?
I certainly don't see it coming down. We've got, like I say, you got $2 trillion in fiscal deficits. You just can't have a recession when you're running that kind of expansionary fiscal policy. And we still have relatively, tame monetary policy. If we have a recession, a serious recession, which we might, then I see interest rates going down. I'm not sure if I see inflation going down. We could end up with stagflation, which would be the worst of the worst. And from everything I see, we're looking at a significant supply shock coming with these tariffs on China. I saw the ports. LA is looking for arrivals of cargo ships to drop by 30% next week. If there's nothing on the shelves of the store, then prices are going up. And remember that Walmart, about 80% of what you see in a Walmart comes from China.
Yep.
So what's your sense, if you have one, of when this comes to a head again and we start seeing, some headlines of some regional banks having issues?
Well, I thought that was last year, but like many others.
I did too. It kind of started. I think, SKRE got to like 10, 15 million in AUM. And I'm thinking this is going to be great. And then it all disappeared. And so I'm waiting again.
The market can be irrational for longer that you can be liquid or solvent.
John Maynard Keynes. Yeah.
One of my favorite scenes.
One of your favorite quotes.
Let me add a couple data points to this convo, right? You said total CRE exposure is 554% of total equity. Seems insane. Among banks of any size, like 1,800 have CRE exposure over 300%. Kind of saying that this is like, these are big. This is $4 trillion in commercial real estate, so it's a pretty big deal, right? It's like the subprime crisis, you've said. Debt service ratio is just lousy, like 0.54. And anything to add there?
Well, there's this what we call the maturity wall of worry, which is how much is maturing this year. And last year it was $1 trillion, but about a third or more of that got extended and pretended into this year. So it's over $1 trillion again this year. And virtually all of those mortgages were originated back when we were in a 3%, 4% range. So they're now having to refinance in this coming year at 6 to 7%. And virtually none of those properties are cash flow positive when you add that kind of debt service to them. And I don't care if it's an industrial building in South Florida that's 100% leased. That sort of financing cost was not built into the projections to make these properties work. And then you go to somewhere where occupancy rates are down, and then it's even worse. So you take example of a $100 million office building financed 5 years ago. It was a 3% mortgage, 50% loan to value. Today, you go back, the banks are saying, hey, I still think it's worth 50 million. So I'll renew the loan, but I can only do 50% loan to value. Now it's worth 80. So I'll loan you 40. So now you not only got to go from 3% to 7.5%, you got to come up with an extra 10 million in equity.
Right.
And so what a lot of them are doing are going for mezzanine debt financing and paying 15 to 20%. And I just hit a post on this a couple of days ago.
I saw that. I was
the mezzanine lenders that are the ones that push this over the edge. Where there was a building where the mezz lender essentially bought the first mortgage from the bank and to protect their position, because once they're starting to lose money, then they can either watch their position go totally under or not.
Or
and the interesting thing, most of the mezz loans are not loans that are secured by the real estate; they're to the developer or the borrower.
So I had a question. Are we going to see the REITs, the commercial REITs drop down again? Because that was really fun in 2020. I got a killer position out of that.
Well, what I thought was going to happen is that you see these properties that actually go into foreclosure and are sold at auction, and they're selling at 50 cents or 30 cents on the dollar.
Right.
Those then become comparable sales for appraisers and for bank examiners. Right. So I expected that contagion to spread across the industry, and it just hasn't happened. And one reason is that this is a fun one, when you modify your mortgage and extend and pretend, if you don't go every 365 days, I'm told you don't have to get a new appraisal. So there are new appraisals. So they're being modified and extended based upon an appraisal from 2019.
That'd be bad for me.
Wow.
So Jeremy, I think that
this is Matt's head turn moment right here.
What's that?
This is your head turn moment. After that one,
shorten something.
Yeah, no, I felt the head turn coming, Matt.
No. I mean, I thought we were sitting on a house of cards. It's worse than I had thought. Well,
that's what I meant by head turn. This was an actionable idea. You were turning your head. Matt usually does his head turn to the left when he's going to drop a trade.
No. I'm already short the regional banks. I don't need. I don't need to drop a trade just yet.
Are we kind of done with this? Because I got another thing to talk about, if you don't mind. So, we're good, right? Because we covered it. Real estate. We know. I don't even know what to say. I don't know what I can
I already have
say,
a watch list going. Go for it.
Yeah. Okay. So I just read the other day, a Rebel, that the S&P lowered the city of LA's bond ratings. I live in LA. Seems like an area you'd know. What do you make of that? Is that even that big of a deal? Or, besides the obvious, interest rates go up, but what does this really mean? I live in LA, by the way. So what does this really mean?
Why are they getting downgraded? They're getting downgraded because their tax base is getting eroded. So especially these big blue cities that are not safe to live in, but put that aside, where you have the commercial real estate values are plummeting. Like San Francisco is a classic case. LA's not quite as bad, but close. Where the actual vacancy rate's 20 to 30% in office, and the shadow vacancy rate's 50%. The value of that commercial real estate has dropped by over half, which means that tax revenues have dropped by half. So that's one of the big problems. Is the revenue outlook for these cities is just dire. It's grim. And so the bond rating agencies are saying, hey, you're not going to be able to keep funding the stuff you're funding. So I'm going to be downgrading your debt.
And so obviously not good for muni bonds, right? That's clear case, right?
And guess what the number 2 exposure of banks' securities portfolio is after RMBS? It's munis.
Let me guess, munis. Wow. Huh.
Yeah, we're not a big fan of munis here. I think people buying them a lot of times let the tax tail wag the dog. And I think there are better a lot better things you can be doing with your money than munis. But I think bottom line is, Pat, you need to move.
Yeah, yeah. You
Dude,
know, the East Coast is nice.
if I turned this camera on and you saw my pool and my view and like my smoker, you'd be like, dude, you would not leave this spot. I mean, this is as cooler than
Then we'd
Rebel.
be like, dude,
This may be as
where's
cool as
our
Boca.
invite?
Trust me. This is almost as cool as Boca. Trust me.
I'm looking out over the beach at Delray here, and
Dude, Delray's my best friend lives in Delray. My friend who graduated from FAU, Matt Zemak. What up, Matt? He's I had a mortgage business in Boca, right? I told you, and I sold it way back. And but Matt was my first employee. I actually met him on the beach at the end of the street in Boca, the main beach, whatever it's called. We were down at the beach hanging out. He was like a college senior, and I hired him. He was my first hire. He was like my first broker I had. But anyway, new topic, right? Not new, but old. We talked about tariffs. And I read today that Amazon is going to start posting like the tariff on like their webpage or whatever. It's just bizarre, I think. I don't know. And then these companies like Temu and all that, right? So like Temu prices have jumped like 120%, blah, 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 blah. I mean, are Temu prices a big deal? Is this a big deal or not? Or, what am I missing? Why do I care if stuffed doll from China is now $4 and $8 or whatever? What does that mean?
Oh, this Temu stuff, that just infuriates me. There was some sort of exception to the rules where they didn't have to pay tariffs, so it comes in lots of less than $800. So these Chinese companies, they just chop everything up into these little lots of $799, and then they're able to sell it for dirt cheap. And it's, mostly crap anyway, but it's cheap crap, and a lot of people are happy to buy cheap crap. So now they're going to have to buy expensive stuff, and so then they won't be buying Chinese stuff. This is really going to destroy China. That's what I've seen.
I think it's
Chinese economy is already in trouble with
Yeah.
commercial real estate, residential real estate. This is just like a double blow. This is really going to hit them so hard that I'm worried that they're going to do something to change the story by moving on Taiwan. But that's a whole nother story.
Yeah, it's going to be interesting.
Maybe it's not, but so I was going to ask, like, what are the implications of that then? I mean, what would the implications be?
Well, just imagine what that would be if the 90% of all the high value chips come out of Taiwan. Taiwan blows up the foundries. For 10 years, we don't have any high value chips. We're talking about a massive, massive recession.
An invasion of Taiwan would be a massive deal. Taiwan Semiconductor supplies, like you said, 90% of the chips. Any delay or any issue with that would be massive, which is one of the reasons why the whole kind of push towards bringing some of these supply chains onshore, having that exposure to, a disputed island is not the smartest, not the smartest strategy when we need those chips.
Yeah, but it wasn't just chips. You go back to the pandemic, you couldn't get you couldn't get gowns and gloves because China refused to send them. So these are national security issues, and tariffs have one really good role, and that's to protect national security. Steel, you can't build ships without steel. We don't make steel in the U.S. anymore. If we get into a hot war with China, once they start sinking ships, they'll be building them right and left, and we're not going to have any.
Yeah, one of the we're big fans of Palmer Luckey, and he did an interesting podcast with Sean Ryan, and he gave the statistics of U.S. shipbuilding. And I remember, I'm a student of history. I remember all the stuff we did in World War II, how we're spitting out Liberty ships left and right. And he gave the statistics for us versus China now. I don't remember what they were, but that was a head mover, Pat. Where it was, oh my God. And then, of course, I missed the trade on Huntington Ingalls, which is the long trade based on trying to bring shipbuilding back here. That chart's gone.
Little known fact about those Liberty ships
in America. Where could you go? Where could you build? Where do they build ships? Is it like in Maryland and these places? Like, where do they build ships? Rebel, do you know?
I think there's.
Well, they don't. That's the problem.
Oh, I see.
Yeah.
Very, very few. I think the stat was that China can build 100 ships for every one we can build in a year.
Yeah.
Right.
And a little known fact, I mean, some of those Liberty ships were made out of reinforced concrete and some steel. So it was crazy.
As long as it floats.
It float. It made the trip a few times. That's all it needed. And then it just, at the end of it, they just scuttled them because they were just concrete. Pretty crazy.
Okay, so Rebel, this is a stock show, investment show. Do you have any picks, any ideas? Where can we make some quick money? Jeremy's got his finger on the trigger over here, as does Matt.
Well, the regional banks are difficult because if you think they're going down, it's very difficult to short them because a lot of them are illiquid. So
just so you
makes a lot
know,
of sense to me.
just so you know, the way I structured CRE is we're short CRE, which is the big regional bank ETF. For that very reason, you can short the top, 10, 15, whatever. But once you get down the spectrum, you're right. So sorry, go ahead.
No, I was just going to say that an inverse regional bank index sounds really smart.
I think that's going to get some
I
attention.
think I'm really smart.
So, no, but I actually meant, I didn't mean, not in the same thing, but like any, other ideas you have, like, McDonald's or, something that's going on in Florida or, what do you like?
I'm not really a stock picker. I'm really kind of focused on the sort of big picture of real estate. So I'm hoping to pick up some good stock tips here today.
All right, Jay.
I am a big fan. I'm a big fan of Palantir.
I got one for short term. And I don't know if I'd short it here, but if you look at like commercial real estate, I mean, one of the biggest inverse balance sheets on the planet was AMC. Their debt to asset ratio is huge. So if you start looking at, entertainment venue commercial real estate, I wonder if that's going to be in trouble next. I mean, AMC got destroyed once people started realizing what the balance sheet looked like. So
you mean in more trouble?
Right.
If you're looking at the chart of AMC.
Yeah, I wouldn't buy it or sell it here. I just walked away. But the issue is like, yeah, it was a meme stock. It got all kinds of attention and stuff. But like when people finally started looking at the balance sheet and realizing what the debt to asset ratio was, it was insane. And there was just no reason to be there. Well, the same goes with commercial real estate. I mean, now we've got kind of companies calling people to come back to the office, trying to utilize their investment, obviously. But I mean, we're still kind of hybrid. We still got a lot of people, or enough of a lot of people working at home, or even a hybrid schedule where they're 2 or 3 days in the office, what have you. So I mean, the utilization of the properties is going to be kind of one thing to focus on. But I wonder what the next step is once we get all the other stuff in line. We got the quantum computing. We got all these other things that can make it even easier for people to work at home in that respect. I gotta wonder what is going to happen to the end of things when things are done being consolidated. I want to think a little bit further forward than that.
Jeremy, I just want to follow up on your thoughts about work from home. So I mentioned this thing called the shadow vacancy rate. So like San Francisco, the actual commercial real estate vacancy rate is 30%. Right. But of the 70% that are occupied, most of them are only being occupied 3 days a week. So then if you factor that in, it goes up above 50%. Well, now think about what happens when the leases underlying these properties, they roll over in the next couple of years. And the companies realize, I've got 100,000 square feet and I only need 50. So it's going to get worse, a lot worse, as these leases are either not renewed or renewed, at half the space. And it's especially going to be bad in the cities. And we didn't mention that just because they're not in the office, that also means they're not shopping, they're not buying, they're not having lunch. So retail has gone to hell in the big cities. The stores at near the subways in DC, for example, are closing down. All the restaurants are closing now. You can't find where to have a good lunch anymore.
I mean,
then also it spreads to hospitality because then there's no business travel, and so the hotels in the blue cities are sitting vacant. So it spreads to just about every property type except for industrial.
What I mean is like who ends up consolidating that? So when these go under, when these properties, I mean, the value falls in half and someone's got to liquidate them, what becomes of all that? Do we convert them to apartments? I mean,
Yeah. There's an interesting, I've seen some presentations of this. Surprisingly, one of the biggest impediments to converting an office to apartments or some sort of multifamily is sewage capacity.
right.
They just don't have the pipes to handle the sewage that you need to have apartments relative to have office workers. And so my estimates I've seen, it's only about 5 to 10% of offices are even candidates for conversion to multifamily. And most of those are going to be prohibitively expensive. And then add to it, the city fathers want it to be for affordable housing.
Right. So, I mean, it can't make that work because they don't have the pipes. I mean, the other option is what, indoor farming? I mean, we're kind of
Or
spitballing
you
here.
see more states and municipalities get downgraded.
The
Right.
other option is to tear them down. That's 50-story building, tearing it down is not cheap.
Nope. That's
Right.
the thing is like, what do you do with it? Because I mean, if it costs you more to tear it down than it does to repurpose it, where do you stand on that? I'm gonna start.
And also, if you think vacancy rates are high now, wait till AI comes,
That's what
full bore.
that's what I'm
Let me
getting
ask you
at.
let me ask you a two-part question, Rebel, right? So the first part is like, is there a Trump or, does this change from Biden to Trump? Does any of this, mark to market or whatever the words would be? And then the second question really is like, what is the market missing here? I mean, is it just this massive mark to market that's going to happen and there's going to be a bomb drop next week, next month, next year? I mean, like, is that the answer?
Well, the first part, I don't think that you're going to see any change in the fiscal deficits under the current administration. I think we're still going to be seeing $2 trillion a year in spite of Doge. Doge is a 100 near and far, and they come up with maybe $100 billion and not a trillion. So I don't see that's going to change much. So we're still going to have, massive fiscal deficits and, keeping interest rates high. I don't see any major regulatory changes coming under the administration. And then the second part of your question was,
Like, why is this taking so long? Or is it just going to have to happen the way it happens? We're going to have to wait for the shoe to drop. I mean, is that the only answer?
I'd take you back to 2006 when many very smart investors knew the housing market was overvalued, knew we were in a bubble, and were betting that it would blow up, and they went bankrupt because the market didn't really turn south for another 12 to 18 months. So I think that's where we are now. We're in the fifth inning. Things get bad in the seventh and eighth inning, and so it's going to be another year or so before this all works out. But there was a company, what was it called? There was a hedge fund that figured out how to short. Well, they bought the toxic waste of the CDOs.
Right, we were just talking about that.
25% and used it to finance their short. So they were able to wait out the market.
The Big Short. I forget the guy's name, but yeah.
So Matt, you brought me into all this SKRE stuff. So like, after you've heard what Rebels had to say, like, what is your take? Has it changed? Has it gotten more dire, better, worse, the same?
No, I mean, I think if anything, more dire. Because I didn't know the statistics, and now I'm looking at them. I also didn't know about the RMBS and how big an issue that was. So yeah, I mean, I think more dire. For that product, I wish we're in the seventh or eighth inning, but it is what it is. I'll wait it out, and we'll have the top performing ETF in the country again.
You mentioned RMBS. What is RMBS? It's a portfolio of residential mortgages. The banks also have $2.5 trillion of residential mortgages on their portfolio that are not marked to market.
Yep.
And they're in equally bad condition.
Right. Let me ask you another question, Rebel. Let's say you walk into a Caldwell Banker or CBRE, commercial real estate office today and started talking your talk, in front of, 20 commercial real estate brokers. What would they say? Or what do you tell them? I mean, you guys go find another job or, what would you say? Or how would that conversation go?
Oh, I've done that.
Oh, okay. Well, let's hear
Oh,
it.
yeah.
I think they
Oh,
already
yeah.
know.
Things are terrible, but
Yeah.
we'll learn how to be workout guys.
I mean,
All right.
I was a
Like
kid
me.
working at a bank that competed with Washington Mutual right across the street, and in 2003, I saw that coming, and I didn't stick around in that industry for very long because even being some punk kid starting out in banking, I realized that instantly. Like, no, this isn't going to work, and here we are. So I got to imagine that these guys at Coldwell probably feel the same way.
Well, but also, watch The Big Short.
Yeah,
A lot of times when you're in it, your head is in the sand because it
true.
has to be. I mean, your revenue, your salary is based on all this stuff. So yeah, there are probably some smart people who see what's coming, and then other people who don't want to see what's coming.
I just invite you to go listen to the earnings call for some of the banks at the top of my list, like Zion or Bank OZK or Eagle Bank. So I mean, it's like they're the most optimistic people in the world, and the analysts on the call are not much better.
Yeah, and Zion is shortable. I mean, I prefer puts. I have had puts before on Zion. So
All right.
that's a good one.
Okay.
Oh, man.
I got one more question. Maybe this is my last one, and it's not probably a great question, but it's worth asking, I think. So is there a difference between, commercial real estate and the banks themselves? I mean, could one do good and one do bad, or it's just going to go down together? Any thoughts on that?
Well, yes and no. On the one hand, but on the other hand, it's what is it? Truman said, "Give me one-handed economist." But I'm sorry, there are two groups of banks. There are as you said, there's 1,800 banks with CRE exposures over 300%, and there's another 2,000 some that don't have those kind of exposures. So the banks that are not exposed to commercial real estate are not going to get taken down when this bubble bursts. In fact, they'll probably do really well because they'll be picking up the carcasses of the failing banks at pennies on the dollars with FDI assistance to cover their losses. So I think we're going to see a huge consolidation in the banking industry over the next couple of years, where we see 1,000 banks disappear, largely through these either forced mergers or FDIC-assisted transaction. So I do see it being fatal for a lot of these banks. They may not fail, but there'll be a shotgun wedding, and they'll have to merge, and then the rest of the banks will be fine. And the big banks, remember when J.P. Morgan was $2 trillion, they're too big. They were up at the limit. Now they're 3.6 trillion because anytime a big regional bank fails, they say, Jamie, can you take this one off our hands?
Right.
And it just J.P. Morgan ended up being 5 trillion by the time we're done.
Good point.
Maybe that's the one to buy.
Yeah.
Okay, so follow-up question. That was going to be my next question. So do you think if JP Morgan bought Zion, let's say they announce it right now and they stop trading, would both stocks go up or both stocks go down, or what do you think would happen?
I don't think that's going to happen because you're not going to get Zion's management to agree to any stock price that is rational.
I see.
Yeah, Pat, the only way that happens is if Zion's is going under.
Is if the FDIC tells
and then it's a forced sale, and Zion's is already down a lot. And, probably JP Morgan gets it for pennies on the dollar, which helps their stock price.
It's so like JP Morgan opens up 5 the next day or whatever is kind of my point. Yeah.
It's like so big, this doesn't move the needle at JP Morgan. $100 billion added to 3.6 trillion is just not that big of a deal.
It's like the stages where you get to grandiose delusion, and then you realize what it's worth, and that's usually a lot lower than what you think it's worth.
When I started in this business back in late 80s, Citibank was the biggest bank in the country at 250 billion. Now they're 10 times that big.
Right. All right.
A lot of money.
It's like Jeremy.
Oh, not that
much. Okay. So anything else, guys? Matt, anything?
I mean, I don't have anything.
I think
this was great. I mean, I'm feeling better about CRE.
I think I'm going to jump into a rabbit hole myself. There's a lot of stuff for me to look at now.
So, Rebel, you have anything you'd want to say? Any final comments? Anything you want to pitch? Like any of your classes? Whatever you want to talk about? Give you a few minutes. I highly recommend going to FAU, man. Boca is just beautiful. Trust me, it's the best.
We have a wonderful executive education. Here's my executive, it's over here, executive education program. So we have MBAs, Master's Finance. We have an executive PhD program. So even if you got your MBA, we've still got more alphabet soup for you to put behind your name. So
Got it.
I teach. So if you want to get my perspective, come on down here. And
So you teach classes?
Oh, yeah.
Like what are your, last thing, I'm sorry, what are your classes?
I typically teach in our executive MBA program. I teach corporate finance 1 and 2, and then I teach a course in our executive PhD program in basic finance.
Got it. Okay. Awesome. Wow. All right.
Very
Something to
cool.
look forward to. All right.
All right, cool. So we'll end this a couple minutes early. This has been great. I'm gonna put a link to your website in our newsletter tomorrow.
Okay, the new banking data comes out about May 15th. So I'll be updating all my charts on the Banking Initiative website and on LinkedIn. So we'll get a new data point coming in, and it could be quite interesting.
All right.
Okay. Well, listen, if something starts shaking out, will you come back? I mean, if suddenly we have a big down day, can we bring in like on a 10-minute notice or, 8-hour notice and have you talk about this one more time with us?
Sure. Yeah. When
you can take your victory, you take a victory lap.
We see the first regional bank collapse. I'll be happy to come back.
All right. Sweet. I'm calling.
I'm gonna start picking
right.
through your listing and doing some technical analysis. Like I'm already doing it. So.
All right. Sweet.
Cost list, the uninsured deposits, and the commercial real estate.
I'm on it. I'm getting to
Hopefully
work
sooner
right
than
now.
later.
Heck
For
yeah.
Matt's sake.
Yeah.
All right. See ya.
See ya.
All right,
Thanks, guys.
guys.
Bye.